So in the final chapter of macroeconomics in year one, we'll be taking a look at macroeconomics objectives and policies. So this is just the idea of how you can adjust aggregate demand, aggregate supply, and some of the other objectives that you have. So in this chapter, some of the key definitions are demand side policies. So these are actions taken by government or monetary authorities to shift the AD curve. So the idea here is that normally if I want to change my inflation rate or something like that, there's different ways I can do it. And that is either by increasing AD or reducing AS or different things I can do over there. So demand side policies, if you want to think of, are basically any policies which affect aggregate demand. So aggregate demand is consumption, investment, government spending, and exports minus imports. So to be honest, any of the government's policies which affect any of those factors will be considered as demand side policies. So basically you're shifting the AD curve by doing that. Then you've got fiscal policy instruments, and the only thing you need to think of when you think of fiscal policy are the words taxation and government expenditure. So it's basically how governments use taxation and government expenditure in order to affect AD. So that's what fiscal policy instruments specifically are. How has taxation changed? How has government expenditure changed? And you'll probably notice that government expenditure is probably linked back to demand side policies, where you have government expenditure as part of the AD equation. Then we've got something called incentives. So incentives are factors that basically make the labor resource more effective. So if you give someone higher pay, then because they're working harder, then that will basically incentivize people to work even harder, because then they know they can get paid more money. So stuff like bonuses, performance-based salaries, incentives where you might say, I'll give a subsidy to people in this area if they, do well. All of those can be incentives, anything that encourages people to work harder and more effectively. Then we've got infrastructure. So infrastructure are just the capital assets which enable resources to move and be moved. So basically just like roads, highways, and all of that kind of stuff. Infrastructure can also be actually stuff like hospitals and stuff like that. They don't necessarily just have to be moved and be moved. It can just be anything like hospitals, schools. They can also be considered infrastructure. Power grids, all of those. Then we've got a trade-off. So a trade-off is basically when you get one policy or something is achieved at the expense of something else. So that's what the trade-off is. I might want to pursue policy B, but as a result, I have to give up policy A or something like that. It's always, to do something, you always have to give up something else. And then finally, we've got sustainable growth, and this is growth which does not compromise the welfare of future generations. So you could have a lot of growth, but you might be doing that at the expense of, the environment and the long-term future. So sustainable growth is when you take that into account, and actually your growth that you're achieving now isn't affecting the growth of future generations. So those are pretty much most of the definitions in this chapter you need to know for macroeconomic objectives and policies. As ever, if there's any that you don't understand or there's any definitions you would like to see, then just please comment below. And also you can just download the sheet as always in the description down below, print it off, and you can revise from it. Hopefully this was useful, and I'll see you in the next video where we will be taking a look at year 2 definitions.